Hey everyone, and welcome back. So in November of last year, I released version 4.0 of my free stock analysis spreadsheet. And in that video, I gave an overview of what the spreadsheet does, but I didn't exactly show you how I analyze a business and what it is I'm actually looking for once I've entered the data in on each of the major sheets in the spreadsheet, and how I actually use the spreadsheet to quickly analyze a business and determine whether or not it's worth spending more time looking into that business. Because as Buffett and Munger style investors, really what we're going to be doing is trying to sift through hundreds, if not thousands of different stocks and different businesses, and we need a way to quickly eliminate most of them and then figure out which of the handful of great businesses are worth spending more time on so that we can figure out if they are a great company and what price we should be investing in those businesses to get them at an appropriate price. So that's what we're going to do in today's video. Go ahead down into the description below and download yourself a free copy of the spreadsheet, or you can just head directly to www.hamishhodder.com/spreadsheet. Also, I'm going to be using a website called Ticker, T-I-K-R, for getting all of the data needed to fill out the spreadsheet. Head over to ticker.com/Hamish Hodder if you want to make a free account and follow along and maybe analyze a stock for yourself, following the same similar process that I'm going to show you in today's video. The free account has a ton of features, but if you want more, such as 15 years of financial data, full global stock coverage, and more, there's currently an amazing deal for the pro version. All of the information about that is down in the description below. All right, so if you head to the link in the description below to download a free copy of the spreadsheet, you will get to this page and you'll see that there's a number of different versions of the spreadsheet, so you can try older versions if you want. I keep those there because in some previous videos I've used the older version. But today we're going to be taking a look at the new versions here. There are 4 of them. And the reason why, first of all, there is a 5-year spreadsheet and a 10-year. I always use 10-year because I want to look at companies with at least 10 years of past financials, but I know that a lot of people like to analyze newer companies and like to look at over a 5-year period, so that's why that is there. And then the difference between the 2021 and 2022 is just which is the latest financial year for the company. So for something like Thor Industries, the latest financial year is 2021, so you will want to use the 2022 spreadsheet. So it's for 2022, the year 2022. The 2021 is if the company does not yet have 2021 financials available. Also, once you click and open the spreadsheet, please read the instructions. Do not request access to edit this spreadsheet. I will repeat that. Do not request access to edit the spreadsheet. This is a template spreadsheet. You cannot edit it. You have to come up here, File, and click Make a Copy, and then save a copy of the spreadsheet on your drive. You do not need to request access. You can do it all on your own. The first thing you're going to want to do is enter in the ticker symbol for the company. Now, you can, if it's a US company, probably just enter in the actual ticker symbol. THO for Thor Industries is the company we're using as an example. But just to be safe, use the stock exchange ticker symbol as well. The easiest way to find that is by simply searching for the stock and then copy and pasting it from right here on Google. Then the next step is going to be to enter in data in all of the white cells. So anything that's grayed out, just leave it. That is going to be calculated automatically, but all of these white cells need to be filled in. And the easiest way to get this data is to use something like Ticker, where you can simply head over here and find all the data that you need. So for example, this top line, sales or revenue, and also, by the way, there's little notes on each of these. So anything with a little black corner on it, you can use that as a little bit of extra information. So sales or revenue is of course on the income statement. It'll be this top line here. You can simply come along and copy and paste the entire line. And if you paste it into the spreadsheet by selecting Command Shift and then V, instead of just Shift V, then it will copy it in the format and it won't mess up the font and the size of the text. So you'll be entering in revenue, that's on the income statement. Earnings per share is at the bottom of the income statement. Equity is, again, fairly close to the bottom of the balance sheet. You'll need to enter in current assets, which is on the balance sheet, current liabilities, which is on the balance sheet, total liabilities, which is also on the balance sheet. And then on the cash flow statement, you'll want to enter in cash from operations. That'll be the first sheet, but that's not everything that we need to enter in. Heading over to the next sheet, we have Capex. So this is capital expenditure. So if you head back onto the cash flow statement, you can see there is a capital expenditure line here. You can copy and paste that into the top line where it says total Capex. You will then want to, if you really want to be accurate in your valuation and your assessment of the business, you'll want to estimate what is maintenance Capex. I'll leave a link to a video where I go in detail about how you can do this. I'll leave that video linked down in the description below, but you may want to estimate a percentage. Or in some cases, like Thor Industries, the business we're looking at now, maintenance Capex will be explicitly given to you in the annual report. So in that case, you can just manually enter in the maintenance Capex figure for each year in this bottom line, and it will bring that figure across to the data input tab over here. Then finally, you'll want to head to the ROIC, return on invested capital sheet, and you'll need to enter in long-term debt. So again, back over to Ticker and head over to the balance sheet. And if you scroll down, there will be a line here for long-term debt. Again, just copy and paste that over. And that is all of the data input that you need to make. So now that we've gotten that out of the way, and again, if you want more details about how to enter in all of the data, I go in a little bit more depth in that version 4.0 spreadsheet video. I'll leave everything that I talk about here linked down in the description below, so you can check that out if you want. But from here, let's talk about what I'm actually looking for and how I'm actually analyzing this business now that the spreadsheet is filled out, and how we can decide whether a business is worth looking into further. So the first thing I'm going to be looking for is the debt ratios and the return on invested capital. So here are the two key debt ratios that we're looking for. We have a current ratio and a debt to equity ratio. For the current ratio, ideally we want this to be above 2, as I've said in the little note here, if you click on debt ratios. And we want the debt to equity ratio to be below 0.5. Now, that's in the best case scenario. I would say at a very, very minimum, you want to see that the current ratio is above 1, which in this case, it is well above 1. That's why it's got a yellow there. And the debt to equity ratio, at the very most, 1. So for this company, it's actually above 1, and there are some exceptions to the rule. In this case, Thor Industries is above 1 because they just made a couple of major acquisitions and they used some debt to do that. And on top of that, Thor Industries has a track record of using debt and then paying it back down to 0. You can see here in 2016, they took on some debt for a Jayco acquisition, and then they paid that debt down in 2 years. So I expect they will be doing a similar thing going forward from the more recent acquisitions that they've made. Then we get a quick summary of return on invested capital, and we're essentially looking for this figure to be above 10% consistently. So that's why we look at the 10-year average and then also the 1-year average. And then of course we can head over to the ROIC tab for a little bit more information. Here we can see how each line in return on invested capital is changing over time. So here's the formula that I use for ROIC, cash flow for owners divided by long-term debt plus equity. So we can see all of those lines there. And what we're looking for, as I said, is for this to be consistently above 10%, which you can see it is. We're also looking for it to be accelerating over time in the best case. So we want to see that the graph is going up and moving up over time. And the reason why we look at ROIC is because it's a demonstration of management's effectiveness at investing within the business. So management has this cash flows coming in every single year. So they have, 240 million, 300 million, 390 million. Each year, this is the cash flow coming through the business, and they have to decide how they're going to reinvest it back into the business or what they're going to do with that cash flow. Some will stay in the business, some will be distributed as a dividend. And the ROIC is a demonstration of their effectiveness of investment within the business. And then the other thing we're looking for is outliers. So is there something strange about the graph? Is there 1 year where it's a lot lower than previous years, or 1 year where it's negative? And if that's the case, figure out why that's the case. Dive into the annual reports and learn about what happened to drive that decrease or rapid increase in efficiency. So in this case, what I would want to look at is what happened in 2019. and why they were a lot less efficient after 2019. The answer in this case is that they made an acquisition. So, of course, when they make an acquisition, they take on a lot more capital in most cases, and usually profits don't reflect the synergies of the two businesses merging together or the acquisition until a couple of years later. So it's very, very normal for a business to lose efficiency and then see it recover in the following years. That's what I'll be looking out for with this business. What you'll also see on the left here is an interesting table that shows us a couple of things. One is the total amount of cash flow for owners, so the total amount of profit produced by the business over the past 10 years. So it's adding together all of these years, and it's $3.2 billion. It then tells us how much debt increased over that time and how much equity increased over that time, and then the combination of those two, which is how much capital increased over that time. And why this is useful is we can have a look at a comparison between total cash flow produced and the increase in equity. So what this tells us is if they produced $3.2 billion worth of cash flow, but equity only increased $2 billion, so in other words, they kept $2 billion in the business, reinvested it, then there's about $1 billion, maybe even a little bit more, that was not kept in the business, that was likely distributed as maybe share repurchases or dividends. So it gives us an idea of, okay, Thor Industries is keeping about 2/3 of their money in the business or their profits in the business, and about 1/3 is being distributed out to shareholders. And we could confirm that by heading over to the cash flow statement, looking in the financing section and seeing here their history of repurchase of common stock, as well as their payments of dividends, which you can see here is, 90 million, 90 million, 88 million. The growth tab in the spreadsheet is what I use to assess whether a business has a distinct competitive advantage. So the way that we approach deciding whether a business has something unique that's protecting it, an economic moat, as Warren Buffett would call it, we do a qualitative and a quantitative analysis. Again, I'll leave videos to my detailed explanation of management and ROIC and also Moat down in the description below. I've got videos on all of this stuff, so if you want to go deeper, go for your life. There's tons of stuff there. But the qualitative side is to kind of take our understanding of the business to figure out what the advantage might be. And then the quantitative side is to ultimately look at the growth of the business over time, because we want to invest in companies that have consistent growth and show us that customers are consistently coming back to purchase more products in higher volume. So what we're looking for in the growth tab here is that these figures are consistently around 10% or higher. And then on top of that, we want to see that these numbers are either stable over time as we go from 9, 7, 5, 3, and 1, or they're accelerating over time. So the 9-year would be the lowest, and it's getting faster over time. That is what we look for in the best case scenario, because it means that over their 9-year average, if we're averaging growth over the long term, it has been above 10%, but that over shorter periods, it's getting better, that they're actually improving their growth rate over time. And then similar to the return on invested capital chart, we're looking for outliers, and we want to explain why those outliers have occurred. So in this case, we could look at cash flow is probably the biggest outlier. Why did it decline this year when sales went up 50%, and while earnings went up 200%? So what's going on with the earnings per share, and what's going on with cash flow for owners there, even over the 3-year period? That's where I would want to be diving into the annual reports, the quarterly reports, and figuring out what is causing that. Looking for outliers in this way is actually where you learn a lot about the business, especially if you do this over many, many years and look back at the company's history for 10, 20 years, for example. Another thing that I look at here on the first sheet is the cash flow margin. So this is a comparison between cash flow for owners and revenue. So how much of that revenue is trickling down to cash that is available for distribution to us as shareholders. And of course, we're looking for businesses that have stable or increasing margins over time. We don't want to invest in businesses that are getting less and less efficient over time. It makes them very difficult to predict going forward. And it's at this point I can pretty much always determine whether it's worth looking deeper into the business, right? If the business has way too much debt, I'm not interested. If management isn't very efficient at investing capital within the business, I'm not interested. If profit margins are going down over time, I'm not interested. If the business has really bad growth over time, if it's all up and down and lumpy and they have negative earnings per share or negative equity, I'm not interested in the business. So that's kind of usually where I leave the spreadsheet for now. Of course, you can see there's one more tab here, which is valuation. This sheet can only really be used once you've done a deep analysis on the company, because you can't just look at a couple of numbers and then, you can't just look at past growth and go, oh, it's 18 to 16%. Oh, let's just stick that in and project forward. That's really not good enough. You need to be looking at a lot of financial results for the business in the past. You need to be diving deep into the management team and its compensation. You need to understand the industry and the business. And then from there, you can make a reasonable projection about how the business might grow into the future. And that's where you might start to use the valuation sheet. You can, of course, put in last year's or the 5-year average cash flow for owner's figure. I think I'm using the 5-year average here. Yes, I am. And then you could make some projections about growth in the future. Put in your target return here, mine's 15%, have a terminal growth rate, a growth rate for cash flows after the 10th year, margin of safety, 50% is pretty standard. You can enter in the cash on the balance sheet and the debt on the balance sheet and come up with an estimation of what you might be willing to buy the stock at, given your projections forward. But I'll save a detailed look at valuation for another day. That's not really the purpose of today's video, but I hope you guys got some value out of this video and how I'm thinking about quickly analyzing a business and using the spreadsheet to do that. Again, as I mentioned earlier, head over to ticker.com/Hamish Hodder. If you're interested in signing up, it makes your life a lot easier for entering in data and also quickly analyzing businesses just within Ticker before you need to pull the data into my spreadsheet to take a little bit of a deeper look. Leave a like on the video if you enjoyed, hit subscribe if you want to stay up to date with more content that I post in the future. And with that said, hope you guys have a great day. I'll see you in the next video.